All right, let's go ahead and get started. Looks like we've got just about everybody here that was registered. So thanks everybody for jumping on. My name is Stephen Jack. I'm the director of digital strategy and customer success here at BuildingPoint Midwest and Gulf Coast. Today is kind of the first part of our three-part series, construction accounting series here, led by our business development director from BuildingPoint Software Consulting, Mike Pieczynski. So Mike, I'm just going to go ahead and turn it over to you and you can get started.
Yeah, thanks, Stephen. Hey, everybody, and thanks for being here. We really want to make good use of everybody's time here, and I'll get started. So how to manage profitability, not just at a construction company, but really any company. Really briefly on the agenda today, we'll do introductions and then talk quickly about session goals. Risk management plan is really the problem to solve, and we'll deep dive into that. And then from there, it's laying the foundation to solve that problem, which is basically managing profits, which said another way is covering overhead. And then hopefully we'll have time at the end, if I don't talk too much, to answer any questions that y'all may have. Getting started here, according to the Hartford, which of course bases their data on U.S. Bureau of Labor Stats, when we look at construction companies, and the likelihood or the average that they will survive, about 80% are making it through year one, but it gets very alarming after that. A little more than half are still there after year three, a little more than a third after 10 years, and 17% up to year 20. And those are really alarming numbers. And honestly, that's why we're here, a little bit of perspective. I spoke on this topic kind of lightly and passively up until a couple downturns ago. And we'll talk more about this, but when we saw some clients having trouble getting to the other side of those downturns, I started speaking about it more aggressively, doing implementations. And so, of course, that's why we're here today. What's really interesting is one of the senior execs there at the Hartford is telling us that more often than not, the problem is that the company took on too much work. And that was the problem that resulted in failure at the company. And I having been in this industry for almost 40 years now, I understand that, but that's an interesting statement, isn't it? Brief introductions. In terms of you all, we targeted in our messaging owners of construction companies, the CFOs of the group, anybody interested in finance. Said another way, anybody that's looking at the numbers and making sure that we can pay our bills and keep our doors open. That's the intended group here. If anybody doesn't have a financial background or is part of that group of the company, please, more than happy to talk today, and please stay with us. Happy to answer questions, even after, if there's questions afterwards and you want to email me, more than happy to answer those, and we'll answer each and every one of them. In terms of myself, got started as a CPA, did that for a number of years, kind of got burned out, sold the practice, went to work as a CFO at a construction company. And, in looking back, I felt like that's where I really learned what's going on. I felt like in that position, I kind of cut my teeth in terms of what the world's really about and what business is really about. And honestly, I'm thankful for that experience. I was recruited then by a software company. It was actually a competitor of Spectrum, and they were the first to hit the market with Windows-based job cost accounting and equipment cost software. Was with that group. We sold the software when it made sense for companies. We sold it and then we implemented it and supported it. Did that for roughly 25 years. And then about 12 years ago, we started looking at companies offering next generation technology, and also those that were 100% focused in construction and they didn't have a portfolio that it took them all over the place. And that's when we partnered with the then owners of Dexter, well, of Spectrum, who were Dexter and Cheney, and they partnered with us. And 2 acquisitions later, here we are, owned by Trimble. And, you know, we were really, and I'll explain that, a consulting firm that happened just happened to sell software. And we were just tickled, and we're still tickled about Trimble owning Spectrum software now. The commitment to resources, R&D, and enhancements that have value every year, that was important to us, obviously. Commitment to support. Of course, all companies, we see ups and downs. There's a curve up and down there, but the commitment to that, and then the commitment just to listening to customers. We look back every year and are just thrilled about that. I'm with BuildingPoint, coming to you today with BuildingPoint. I sold our practice the beginning of this year, actually, to BuildingPoint. So that's kind of the transition. Incidentally, or a little another comment. I'm talking to y'all today. I could be the CFO at your company who's got a construction background. I could be your CPA that maybe is with a firm focused in construction. I could be maybe a controller, somebody else in that same role. Could be your process consultant implementing Spectrum. What we're talking today is best practice. It's not specific to Spectrum. I'll show you examples on how to do certain things in the software, but if you're thinking about buying Spectrum, if you're on another software and you just are interested in this topic, all of this applies. So it's very product agnostic. Goals today. We're going to talk about covering or about rather best practice for a meaningful chart of accounts that's going to help us achieve the problem to solve that we covered a minute ago. Now, if I were the owner of a construction company, I'd probably be looking at my email right now or something else like, what chart of accounts? Believe it or not, you know, I don't mean to get all nerdy on you, but just like the foundation to a building and different floors going up properly, it's that important. It's the foundation to your system that makes what we're going to talk about today simple. It's that important. We'll also talk about where to focus on your income statement. You know, over the years, I've seen financial statements that there's a lot there, and it's hard. It's hard to get the message that you need out of a financial statement. What's the story? Where's my risk? Where's my strength? And we'll talk about the P&L today to that end. And then thinking about the P&L, we'll talk about indirect job costs in your job cost accounting system. We'll expand on those, and then we'll talk about the nut to crack, and that is covering overhead. Overhead for this conversation is our back office costs. It's what we have to spend to keep the doors open. It's our rent. It's our utilities. It's our accounting people. It's our marketing people. That's overhead. And then, like I said before, we'll have questions at the end of the session. Risk management planning. This is the problem to solve. I make a quick note up top. Any job cost accounting system that's worth its salt should be able to do this for you. But the problems to solve then are knowing what our overhead budget is. You know, those costs to keep the doors open. What's that number? What do we have to cover? And then we need a system, and a system is the software, it's the people, it's the processes, it's everything. But we need a system that helps us measure and manage how much work do we need to cover our overhead, and then hopefully provide the owner some money to take home at the end of the day. All right. And that's really the problem to solve. It's that simple. We also want to know what our real backlog is, because backlog, we look at backlog from a financial standpoint as, well, how much resource do we need, but also how much overhead is covered for how many months. And that's going to kind of guide us on how aggressively we need to go after new work. And then we take on new work accordingly. And I think we just came full circle. If one of the big risks, or if we look at historically companies that go out of business, construction companies that don't make it, and the primary problem was that they took on too much work, we just came full circle. Well, how much work do we need? And there's not an answer today. It's going to be something we watch and we monitor and keep our eye on. But that's why we're here. So, backing up for a second and just keeping this real. And I'm coming to you as a business owner for over 30 years here, okay? But what's an owner trying to do? Why are they here and why are they doing this? Well, in the simplest terms, the owner said, I'm going to probably invest some money and borrow some more to put in infrastructure. I'm going to have an office and I'm going to have office furniture and I'll have construction equipment and I'll have people to do billing and to do marketing and to do estimating and accounting. All those things that are overhead. And then I'm going to build stuff. I'm going to go out and provide services and construction projects to make enough money to cover their costs and then also cover my overhead. All right. It's a pretty simple concept. I'm going to build stuff so I can cover my overhead and then hopefully take something home at the end of the day. So just a little bit of history with those simple concepts in mind. As a CPA firm and then as a process consultant for most of my career, while times are good, while money's flowing, nobody cares about this stuff. When there are downturns in the economy, we have to step back and say, how are we going to get to the other side? Okay. We saw in some of these downturns, we saw some companies getting there fine. We saw others struggling to get to the other side. And there were two commonalities where companies struggled. One was they didn't know where they were at on jobs, or they didn't know if overhead was covered. And again, that's why we're here. But that's historically, we've lived this in terms of the firm, my firm. And so I speak about this pretty aggressively now. Focusing in on that, as a business owner or the people advising me on the financial aspect of the company, we have to focus on what's important. It's easy to get distracted. There's so much going on, but we have to focus on knowing what our overhead is and whether we're covering it throughout the year. If we're not watching that and we're in the red today, if we're going to the bank at the end of the year and there's red on our financial statements, it's too late. We can't look to the bank to help us. What we have to do is measure throughout the year whether we're covering overhead. And it's interesting timing here. We're at the end of Q3. So maybe we're watching at the end of September and watching whether we're going to have overhead covered. And if we're not, that's unfortunately, this is the best we can hope for. We have choices to make while it's happening. One choice is to look for short-term work so that on paper, we've covered overhead through the end of the year and we're not in the red. That's one option. Another option from a financial standpoint, well, we can lower overhead or some combination of those two. That's a choice to make. We can also bring in cash, either through additional capital from the owner or through debt. Now, we're not solving the loss problem, but we're solving the problem at the bank. Now we've got the money to fund that loss and move on to the next year. Hopefully whatever's happening is going to autocorrect or correct itself and we can move on. But those are our choices. And as long as we're watching throughout the year, we have time to look at the choices and think about what's best for our company. The foundation to all of this, number one, we have to budget our overhead cost. The reason I'm saying that is if we budget it, we can watch actual to budget of these items throughout the year and project what we think it'll be at the end of the year. This is no different than a job cost projection. Job costs, we're projecting estimated cost of completion. Well, on the financial side, we have to do the same thing with overhead. We have our budget throughout the year, but we also have to have a mechanism or a way to project what we think it'll be at the end of the year. And of course, that's what's going to hit our financial statements. And then based on that number, how much gross profit do we need to generate to cover overhead? And then again, hopefully have something for the owners to take home. For whatever it's worth, might as well hit this head on early. In terms of your financial statements, your P&L, Most of it just falls out of accounting. There are no variables, all right? It's falling out from accounting. What we do have impact on, or what is a variable that we can control, are your job cost estimates and completion. Spectrum calls those projections, and also making sure that change orders are in your system. Honestly, those are the only two things that affect your financial statements. Everything else just falls out of accounting. We don't have control over that. And we'll talk more about the WIP report and how that comes into play. I'm kind of going down a little side path there, but that's really important for owners and the financial folks to really watch and be aware of. We also, in terms of the foundation, I recommend we look at this quarterly. Monthly seems a little too granular, and we've got an ebb and flow to things and patterns. It's hard to watch that if we're watching it monthly that closely. I recommend quarterly. But by that I mean our overhead costs on budget, and if they're not, through the end of the year, are we going to project certain line items over or under? Maybe rent went up unexpectedly. Maybe we had to hire a new financial person at a different rate. We have to watch those things throughout the year to anticipate end of the year costs. And again, that'll help us to watch is gross profit on our jobs covering that overhead. And I'll talk about that in detail. What we've seen over the years is as companies grow and make it, they have figured out these details. Okay, there is no magic button today. The way a company looks at this and addresses it is going to be different if I'm a $2 million or a $5 million company. The way I think about this. When I get to 15 or 20, we've worked through more details, and I'm thinking about it differently then. When I get up to 60 million, that seems to be a threshold. I've worked through more details, and I'm really honing in on this. And then obviously the 100, the 200, the $300 million companies, it's part of their DNA. And I think that's worth mentioning. It's, based on the size of your company, you may look at this differently. We've been talking about watching the numbers, and just a brief background on the financial statements, on your company's financials, if you're not familiar. Just we'll cover it really lightly. The two common or initial financial statements are your balance sheet and your income statement. And if you're not aware, think of your balance sheet as a snapshot in time. All right, it's like checking the oil. What is that value? Checking the oil in your car. It's like, what is my cash balance as of a certain date? What is my working capital as of a certain date? And by working capital, I mean our ability to cover short-term indebtedness. Can we cover our bills? What does that look like as of a certain date? The P&L or income statement, alternatively, is kind of like the speedometer in your car. What are the financial results from our operations for the month of August or year to date through August? It's what were the results of those operations financially? That's the income statement. And today we're going to focus on the income statement, or the P&L. And I'm watching my clock here as I go. All right. I am a firm believer in a summary income statement to start. All right. What do we need to focus on? Now, some people might call this part of your KPI. We call it whatever we want, but I'm a firm believer in the initial messages and story we need to get. So as we look at this P&L, it's for the 1 month end of January. And in this, I'm saying, okay, we earned $1 million through what we did on job sites. It cost us 800. And so we made from operations, 200 or 20%. My eyes, when I look at a financial statement, when I look at a P&L, I go right to that 20%. And what I'm interested in is, now it'll never be what estimating did, what we did on the takeoff or on the proposal for the job or the as sold. It's going to be different, but can we explain it? If it's 18%, can we explain that? If it's 25, can we explain that? But my eyes always go right here. And then there's a couple more rows here on our indirect costs, which we'll talk about. And then if we're an equipment company, our allocated equipment costs. And here we're just saying, hey, I underallocated some of those, but you can see it's pretty close, and that's what we can hope for. I'll talk more about that. But then what's highlighted here, the contribution margin, is where we're focused. I learned this term. We've gone out for funding a few times at my firm. And every time, whether it was a bank or it was private equity or whomever it was I was talking to, or an SBA loan, they were interested in my ability to cover my overhead. It was that simple. Said another way, what's the contribution margin from operations to cover overhead? And so I made 199, or my company did, and my overhead is 92. So I've actually made 107 through January. Okay, so I'm clearly covering overhead. On your P&L, you're probably going to have more detail. Like in this example, I've expanded out on revenue. Well, revenue is what we've invoiced on our projects and then earned revenue recognition, and we won't get into that today. If you have any questions, please email me. Happy to talk about that, this revenue recognition adjustment. And then what were our costs in terms of our resources to generate that revenue? Well, we had so much in labor, so much in material, blah, 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 and I'm still at my 20%. All right. Now, for whatever it's worth, if a company is on a system that doesn't have a job cost module, this might look different. In any decent job cost accounting system, there are something called phases or cost codes or tasks that break this out so that we can measure whether we're coming in or over budget on these tasks while there's time to do something about it. That's the PM's definition of a phase or cost code or task. That's over in job cost. That's the subsidiary detail. This is just showing us our resources on the financials. The detail that operations is interested in is over in job cost. I think it's important to say, if we had all that detail here, our picture is going to get really muddy. We're trying to do too much on one piece of paper. We have that information just somewhere else. Okay, anyway, as I move on then, I'm coming here then to a whole new concept, and I'm shifting gears here again around indirect costs. The rule is job cost everything we can. That's a simple rule. There are some costs that we can't job cost. They're too granular. And in my example here, maybe supervision, drug testing, safety, on and on. This list will get much larger, and we call these indirect costs. We need them for jobs, they're job costs, but we just can't job cost them. And so best practice is to measure them and allocate them to jobs. And the way we measure them is we create a pool of accounts, and they're all together that way. And then we allocate to jobs based on something. I strongly recommend that you allocate to jobs the same way that estimating assigns indirect costs. When we think about what's our problem to solve, or what are we trying to solve for? Well, the question is estimating using an accurate rate, all right? Well, this tells us right away, and again, I would look at this quarterly. If we look at that pool of accounts and estimating, so let's just say, just for fun, they're estimating 10% of labor or $150 an hour, whatever it is, we allocate the same way. And this tells us then on the financials, without any special project, without any effort whatsoever, how close estimating is when they're adding indirect costs. Now, where this can come into play is if things get tight, if we're over allocating, that tells us that estimating is assigning an arbitrarily high cost to the takeoff, to the budget. And we could potentially be losing bids that way. If the inverse is true and we're under allocating, that's telling us that estimating is not assigning enough to indirect, and we're losing money before we ever hit the job site. And so again, kind of back to that, when times are good, this kind of gets pushed under the rug. We're making enough money. When there's a downturn, this is where these are the details that make a difference. Sorry, allergies are hitting me good, so forgive me on that. a brief note. Gosh, I can't count the companies I've been into where at the end of the year, and this is the old way, the end of the year, the finance people were going through the accounts and picking out what they thought were the indirect accounts. That's important, right? And then doing something in Excel and dividing it by labor hours or labor dollars or whatever. And at the end of the day, coming up with an overhead allocation rate and hoping they were right. I'm thinking, what does that do for you at the end of the day? Well, it tells you we're allocating enough on the financials. Is that really what we want to do? Or do we want to know that estimating is adding the right amount for indirect? Right. It's kind of an easy answer on that. As I go through this, then, well, this is a little bit about overhead. I'm sorry. Let's shift gears now into your back office costs. We have run into companies that allocate overhead to jobs. Now, if that works for you, great. What we've seen as a general rule, though, is project managers can't control overhead. They have no control over rent and accounting salaries and marketing fees and utilities. To ding their jobs on that leads to non-productive conversations. More importantly, is it takes them off focus. What should we be talking about? All right. Well, what we see as the best practice, and whether we're at an AGC meeting or, Spectrum was built to do this, or you're talking to your CPA, this is best practice, is how much do operations folks need to generate to cover overhead? That's an easy conversation. They can control contribution margin. That's where they live. The sales general and administrative, AKA your overhead, that's a financial conversation outside of operations. That's with your accounting people looking at your historical trends. I guess that makes sense. Looking at your trending on what things cost and coming up with a budget for next year. That's another conversation outside of operations, and we'll talk a bit about how to manage to that. But in terms of managing overhead, I strongly recommend we have a contribution margin on our financial statement. We might call it something different. And then this is what operations is tasked with to make this year. And then overhead is between you and your finance people to manage and watch variations in cost. Quick reality check. It's important to mention, don't pretend that your software or your system is going to give you the answers. Your system is a tool to provide information so that you can derive or come to the answers to the questions. All right, that's an important comment to make. If we have any equipment companies in the room, excavators, heavy highway, transportation, you've got a part of your chart of accounts lists your equipment costs. Now here I've listed out my operating costs, the fuel, the labor, the parts, the repairs. I've listed those out separate from the ownership cost. Now keep in mind, there's a listing of pieces of equipment that add up to these numbers, just like there are jobs for job cost. It's important to mention this. These ownership costs apply for standby. We've all been there where a backhoe or a loader or something sitting on the side of a hill and you've walked by for weeks and it's still there. Well, what's that costing me? Well, by separating your ownership costs, you know that. Daily, weekly, monthly, what it's costing you to have that piece of machinery sitting on that hill. And then you can choose to charge the job for that standby time or just be aware of it. But by separating operating versus ownership cost, your system's designed to provide that, okay? At the end of the day, then, we're charging jobs for equipment costs, just like we're allocating overhead. There's no difference. We're allocating equipment costs. And at the end of the day, then, are we over or undering? Are we covering the cost of our shop and of the equipment, including our technicians if we've got techs out there as well? So obviously, equipment job costing is another topic, but I wanted to cover that on your financial statements. this concept that we're talking about now, we've talked about it in terms of my company. Well, some companies have business units. Maybe you've acquired other companies, growth through acquisition, or opened other locations. Maybe you have different lines of businesses. Maybe you've got, I don't know, you're doing hospitality construction, you're doing medical construction, and you want to track those profits to know where you're doing good, not doing so well. These lines of businesses, they've each got their revenue, their costs, their profit. So here I can see that my Plainfield, Illinois, we're generating 20% on jobs. My Springfield, Illinois is 25. And over here in St. Louis, I'm a Cardinals fan, we're down to 17%. And maybe this makes sense based on the market and the bids. Maybe it doesn't, but a decent system will allow you to break out these lines of businesses, and companies then will charge these business units or these different operations units with their portion of contribution margin that adds up to the total to cover overhead. And again, it's the same concept, and it's no more complicated. We just have different business units or things we're doing that are all budgeted to contribute so much to cover overhead. It's that simple. Where unfortunately, during times of economic downturn, or if things just aren't going well for any reason, this lets us look at a financial and know the real effect of closing down a line of business or focusing in one area or another. Facts are friendly. It's right here in our financial statements. There's no funny money. It's simple, and we know if we're going to turn off the valve somewhere, that it's going to have an effect on how much that unit is contributing to cover overhead. So let's get into the software a bit and look at some of the tools to cover these things. I'm going to minimize that. And the first, we've talked a bit about the chart of accounts, and I won't spend much time here, but if we go into general ledger, maintenance, master file, why we can't call it the chart of accounts is one of my peeves. We get a listing of our accounts, and you can see there's a number, a smart number to our accounts. Now, I brought this up in Excel. When I do consulting, I start here all the time. We want our accounts to follow a flow so that there's a logical grouping when I want to do something. So, we're all interested in working capital. Can I meet my current debt? Well, to give you working capital, I've highlighted everything in yellow rather, and we can see on the assets, it's all together. Okay, nice. I can say, give me everything through these ranges of accounts. That way, if I add stuff, it's included. On the liabilities, not so much. You can see the yellow is what I want, but I've got some gaps. When we are designing your system, we try to make everything come together in our groupings so that in 8 months, when you're looking at your working capital, it's accurate. If you've added accounts for some reason or whatever, and they slid in within a range that was outside of the yellow, maybe it's not included and you're not looking at accurate information. So that's one important thing on the chart of accounts. The other is, you're going to notice this is following the flow we've looked at. I've got my revenue, and then in orange, I've got my resources to achieve that revenue or generate it, whether it's on jobs or on service. And then I've got a grouping for indirects in yellow. And then I've got a grouping for equipment costs. And then I've got my overhead. All right, everything's together. When I'm doing implementations for mid-large companies, we go through this, and then I stress, this will work for you as your company grows from 20 to 60 to 200 million. It needs to take an approval from a committee to make any changes to this. All right. What is a variable are your cost centers, lines of business, whatever. Spectrum calls them cost centers. We've got a cost center for corporate. It's going to include our cash. And now the way I do this, a lot of times it includes indirects and overhead as well. Okay, some consultants might have a separate cost center for overhead. I've got another one for my shop. As I go down, these shop accounts are cost center. What that means now is I not only have security over that, but I can have a separate P&L or separate job reports for these things. So I have visibility to financial performance for my corporate, for my shop and my equipment. And then if I've got business unit 1, business unit 1 service, business unit 2 construction, blah, 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 they're all going to have their own revenue and they're all going to have their costs. All right. So again, this enables me, there's different security mechanisms on Spectrum. Maybe one business unit can't see the other business unit stuff. With cost centers, I can do that easily. But more importantly, I can compare and contrast. Maybe I want to compare my total construction to my total service. I can do that with something called cost center groups, cost groups, and I'll show that to you. I can also compare business unit 1 to business unit 2. And I'm making this really simplified, but I think you probably get the point there. In Spectrum, those lines of business or business units, if you're using enterprise, enterprise has been around 10 years now. So some clients have been on the software longer and who haven't migrated, they're not using enterprise. But if you are, we can create cost centers. And I'll tell this rascal I only want to see actives. We can, let me make that a little bigger for y'all. We can set up cost centers that break out these lines of business. One thing your consultant will do with you is have a conversation about how you look at your company. And for whatever it's worth, you can't spend enough time on cost center. You can't. In this example, anything that starts with a 1 is corporate. Anything that starts with a 2 is indirect, 3 is shop, and 5 is jobs, 9 is service. And then jobs are broken down between, my large project, sheet metal division, and plumbing division. So the second and third characters represent the type of work. Through a lot of conversation, where you think you want to go, you and your consultant will arrive at this. It's best practice then. The last digit is a security flag. And you can see all these guys are zeros. I've got a security flag on confidential payroll for corporate. That's probably executive payroll. And we accomplish that confidentiality by breaking confidential people out into their own cost center. They're part of corporate. They're still part of that 1,000. Their security flag, though, is a 1. All right. We can also set up something called cost groups that, that's the ability to compare and contrast. Remember, I said we can all of my construction versus all of my service, or maybe everything for business unit 1 or location 1. We can set up cost groups to report on. We can report on cost centers, or we can report on cost groups. There's no difference in the system. We talked a bit about allocations. And we get this a lot in consulting. So I'll just cover this really well. No, I'll show you the allocations we have in Spectrum. I'm going to pick on a job here, and I'm going to go over to properties and then to payroll setup. I got to make him a little smaller now. Get rid of my favorites. We can see that for payroll burden, let me edit that to make that come out. We've elected to post actual burden to the jobs that we said, hey, for payroll that's not posted, add 12%. That's not an allocation. But then we've told it for our overhead, this should really say indirect. We're saying ding our job with 10% of overhead costs. I'm sorry, back up, Mike. Indirect costs, indirect. Ding it with 10% because that's what estimating does. Estimating alternatively might do an amount per hour. And then we're saying throw that in a specific phase or cost code because that's what estimating does. And we want it to line up and be comparable. All right. Now, kind of burn into memory, these settings, when you set up a new job, they pre-fill from your payroll installation screens. You can change them for specific jobs if it's different. Okay. Now, you might also be using job templates. You might also be using something called Quick Job Setup that controls this for different types. So just kind of be aware that they pre-fill from a variety of different places, and you can change this on a job. Okay, let's hop back over to the PowerPoint. Our WIP report. So we've talked about the chart of accounts. We've talked about controlling indirect. We've talked about watching our equipment costs. We've talked about, to a point, we've talked about our back office overhead. When we do our month-end closing and we are doing our adjustments, we really don't have control over much other than our job profitability. That's the variable. As I was saying before, the only thing we have control over the variables there are the projected cost of completion and the change orders being in your system. They result in your WIP report. Spectrum calls this your contract status. Key takeaways of your contract status report are as sold. When we sold our project, we had a certain gross profit. What does it look like now? Another key takeaway, how many months of overhead is covered by our backlog? And we'll look at that. And then another one is, what are our resource requirements? Another important one is our project managers able to control the financial aspects of the job? And we'll look and talk about what that means. Tips and tricks. When you run the contract status report out of Spectrum, you have this selection screen. Most companies are running the schedule with backlog. Now, of course, you've got your cutoff date. There are these two options for payroll and AP in progress. They should not be there. This is an accounting-driven process. Everything's ready to go. We're ready to do projections, and they'll look at a draft WIP report. It's cut off. Maybe it was the end of August in this case. We've already closed payroll and AP in that case. We're looking at numbers at the end of August. Everybody's looking at the same data, the same numbers. We're not looking at things that are coming in today and tomorrow. You want to be careful also about excluding jobs that were created after, in this case, 8:30. Is that 6:30 or 8:31? I can't read that. And then also about your job status. We have a nice white paper in our helpful files page on the website, on our website, BuildingPoints, that tells you, talks about the job status and how the different statuses affect what you can do on the job and how they affect the contract status report. So burn that into memory. If your company doesn't have it locked in how you close jobs, we've got that white paper on our website that talks about how this affects your processes in the WIP report. As we look at this, then can I move that? Yeah. We can see I've got a listing of my projects. Okay. The first thing I want to talk about is that this Linwood Center, my percent complete is T&M. All right. We've got a different way of looking at revenue on T&M jobs by default. You can change that if you want to. If you're a T&M contractor and this is haunting you, just know that you can change this. I've talked to your consultant about that. The second thing is, I usually hit my fingers and I go down the contract status and I'm looking at my gross profit percent as sold versus where I project it to be at the end of the project. All right. These first set of numbers are the original contract. The second set are my projected at completion. My contract with change orders, my projected cost, my projected gross profit. So this first job, he jumped from 8 to 16%. Is that explainable? Maybe it is, but maybe it's not. Maybe I need to go ask some questions of the PM to help me understand that. Maybe there are change orders. Maybe the cost side of change orders is missing, or maybe something else, who knows? And so that's where my eyes go, is comparing. Then I'm looking at over and under billing. What I'm looking for here are trends and then big numbers. Okay, under billing 97 on a $2 million project. That I've got no heartburn about that. And then I'm looking at my backlog. In this case, I've got 700 and change in backlog to cover overhead. Now, maybe my overhead is 100,000 a month. Okay. I know that I've got 7 months overhead covered with my existing backlog. That's good to know. Should we bid more aggressively? The answer might be no. That's only 7 months. If it was 17 months, maybe that answer changes. If my backlog is a lot less, now I'm thinking about, if it's only June and I've only got, say, 3 months backlog covered, what do I need to do to make sure I'm okay through the end of December? You can see where this comes into play. Let me shrink him back down. This next slide is kind of a little jewel inside a spectrum. You can get to it from a couple different places, but it's showing you how the PM is controlling the finances of the project. For anybody that's bonding, your bonding agent is going through this manually, probably, and not aware of this. But I've got a certain job here, and we can see the dates that are rolling up. And this is where I look. I look at the gross profit. All right, it started at 9, it went up a bit, and then it went down to 6, and then it jumped up to 10, then 12, then 13. All right, maybe there was some confusion here. What was happening that the PM let this go at 6%, you know? And then, by the way, this isn't finger pointing. This is an opportunity to help people. Lord knows I need more help than anybody. This is an opportunity for the finance people to go, maybe the PM isn't really clear on how to know how much to bill or when to bill. Maybe I need to help that person or see if he needs help, he or she. So that's that opportunity. I'm also looking at over/under billing, and we can see there's a strong trend of overbilling, and it's getting larger. The trending is larger. So I would definitely talk about this. Overbilling is just as dangerous as underbilling. And so that we're not robbing Peter to pay Paul or think we have money that we don't. So this is something I would talk to the PM about. Say, hey, what's happening, man? We're overbilling all the time. Help me understand that. And then I'm looking at my cost to complete. I can see the numbers are actually going down and then trending back up and going back down. And I'm looking at my change orders. The change orders support a revised contract that trends up. Okay, kind of warm fuzzy about that. But I'm sorry, projected cost is over here. My projected cost will follow the same trend. I won't go down there, but I'm not seeing the same trending with cost to complete. All right. And I'd want to talk to my PM. Why are we making more money, but our cost to complete's going down? Help me with that. I'm trying to understand that. Whoops. And so that's a value of that contract status report, is to look at a job and look at the financial trends of that job and our ability, it's part of the 3 C's of bonding, our ability to control the financial aspects of that. All right, backing up, if I haven't put you to sleep, considerations and kind of takeaways. Track your job costs. Job cost everything you can. Put your indirect and your equipment and your shop costs in buckets of GL accounts, and then use a contra account when you allocate that up to jobs. That way on a financial, everything's together. There's no special project. It's very easy to know if I'm reasonably estimating my indirect costs in my shop, or whatever else estimating is adding to the bids. Maybe they're allocating payroll benefits, just same concept. No matter what method, your job cost and your financial statements need to be the same set of numbers. This isn't as prevalent as it was years ago. I'd be in clients' offices and I'd hear project managers in the kitchen, I'm making 8%, I'm making 9%. Maybe they were GC, and I talked to the finance people. Yeah, we're struggling. We're at 4% right now in most of our jobs, and they're working from 2 different sets of numbers. We have to have a system where financial statements and job cost has the same numbers and is showing the same results. Regarding everything we've talked about, kind of wrapping this up into a bow, if we're doing these things, it's going to not only show us that we're making money today, but will we make money? And I use the terms in the end of the year. It's going to help us forecast our financial results through the end of the year while there's time to do something about it if we need to. Another thing that a lot of our CPAs will tell us is for depreciation, use the estimated life. Don't use tax life or tax methods. Use a useful life. And what that means is take your cost, subtract a residual value, and that a trade value, whatever, and then do the math for as many years as you think that'll last you. Use that for depreciation. And then one other thing is, you might want to consider for larger organizations, you might consider allocating estimating to your lines of business. Through conversations, sometimes we uncover, well, it maybe takes more or less for certain business units or for whatever, but so that everybody gets dinged with their reasonable share of these costs, consider allocating out to the line of business as well. What works best for your company? Quick recap. We covered the chart of accounts as a foundation, showed how that affects the tools we have to manage. We looked at a P&L and on the summary and on the expanded, where to focus, at least initially. We've talked about managing indirect costs, and then we've talked about how to manage whether we're going to cover overhead for the year. And that's the problem to solve or the nut to crack, And really, I haven't talked much about avoiding taking on too much. Want to mention real quickly additional resources you have. Of course, you have the help files. Been tickled about the gang that's keeping up on the Spectrum help files. We've watched those really just nicely improve over the years. You've also got the Viewpoint Academy with some self-help tools there. Don't hesitate. Your Trimble or your BuildingPoint consultants, we're here for you, for your help. If you're batting around some business problem or something you're worried about, can my system help me with that? Don't hesitate to call on us. And then also on our website, we have got one of the most popular areas on our website. We've got an area for frequently asked questions, and then tips and tricks. Don't hesitate to go there. The URL is there. That gets used a lot. Over the years, we've listened to customers, areas they ask a lot. We want to make this easy for you, okay? All right, I've gone over just not too bad, but again, if I haven't put you to sleep, are there any questions, anything y'all want to talk about in the last few minutes here? Stephen, are you able to?
Yeah, Mike, I went ahead and unmuted everyone. So if anybody has any questions, you're free to jump in with anything. Also, keep in mind, if you did join today, I'll send you a follow-up email with some links that we talked about with the additional resources, and you'll be able to find those quickly and easily that Mike talked about. So any questions, feel free to raise your hand or just speak right up. Everyone should be unmuted.
I've put him to sleep, Stephen. Oh. If anything comes up, anything comes to mind, please email us. More than happy to take the time to answer anything that's emailed into us. Want to mention also, please join us at Dimensions. We're speaking on a variety of topics that we do every year. This has been a career that's been great to me and my family. Give back every opportunity I can, and part of that is speaking at these conferences to share things we learn.
Michael, did you have something? Hello? No? Okay.
All right.
We'll go ahead.
Fishing.
Yeah, we'll go ahead and follow up with an email to all the attendees and get you those links and go from there. Thank you, everyone, for joining, and thank you, Mike.
Thank you.